Well, from a longer term perspective, yes. I mean, most indications are that an NDA-led government would be a market-friendly outcome. They have expressed plenty of basis to expect that they would pursue a number of economic reform measures and deal with some of the structural issues that the economy has been dealing with over the past few years. But having said that, markets are very optimistic that we will need to have a stable NDA-led coalition, and to me that is really the big risk. While I believe the outcome of a fractured outcome is very low, it still is a positive probability. So to me that's the only risk on what looks like otherwise a fairly sunny horizon. Well, in the very short term, you could see recent rupee strength actually extend a little bit. I mean, remember the central bank has been leaning against rupee strength, in the midst of fairly strong inflows into the equity market and using that to really build up FX reserves. So you could see that extend a little bit in the very short term. But having said that, longer term, a stronger rupee does hurt export competitiveness. Domestic inflation is still running fairly high, and it's hard to see why that should come off in a big way, very soon. So both these factors do argue for slightly softer rupee when you look at a 6 to 12 month type horizon. Well, we still like Indian bonds onshore, and we think the big opportunity is still in the very short maturity end of the space. Now, the yield curve is still fairly flat. And we think that short maturity bonds still offer a particularly attractive yield today. To get investments anywhere over the next less than a year to slightly more than a year as well. Long-term bonds are also still interesting for investors who have a long time horizon, but there we recognize that there is the risk of potentially quite a bit of volatility along that path. So to me that is dependent on investor goals rather than being a fantastic idea on a standalone basis.